Good afternoon and a warm welcome to our dignitaries. I am CA Clifford D'Souza, Treasurer of Bahrain chapter of ICAI, will be the MC for today's event. Dear members, before we start the technical session, we will keep participants other than the speakers on mute. Kindly type into the chat box if you need to raise any comment or question. Let us now begin the event with the national anthem of Bahrain, followed by the national anthem of India and the ICAI motor song. Now I request all the members to kindly rise for the anthem.
जनगण मन अधिनायक जय हे भारत भाग्य विधाता पंजाब सिंध गुजरात मराठा द्राविड उत्कल गंगा विंध्य हिमाचल यमुना गंगा उच्चल जलधि तरंगा तव शुभ नामे जागे तव शुभ आशीष मांगे गाहे तव जय गाथा जन गण मंगलदायक जय हे भारत भाग्य विधाता जय हे जय हे जय हे जय 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 हे
य एष सुप्तेषु जागृति य एष सुप्तेषु जागृति कामं 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 कामपुरुषो पुरुषो निर्विमाणः निर्विमाणः तदेव शुक्रं तदेव शुक्रब्रह्मा तद्ब्रह्मा तदेवामृतमुच्यते अस्मिन् लोकः शतः सर्वे तदूनात्यपि कश्चन एतद्द्वैता 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 एतद्द्वैता
Today, we have chief guest, His Excellency Piyush Srivastava, Ambassador of India to Bahrain. And our guest of honor, CA Nihat Jambusaria, ICAI President, and CA Dr. Debashish Mitra, ICAI Vice President, and my beloved Bahrain chapter ICAI members and guests. Today, we all have gathered here on a special occasion to celebrate the 73rd Chartered Accountants Day. This day is observed in order to celebrate the formation of Institute of Chartered Accountants of India on July 1st, 1949. ICAI is the sole licensing and regulatory body for the financial audit and accounting profession in India. ICAI was formed a year before the constitution of the country was formalized and counts itself among the oldest professional institution in the country. ICAI is also the second largest professional accounting and finance body with a membership base of more than 3 lakh members. It is undoubtedly a matter of pride to all the members of such big and esteemed body. And so to honor these members and their existence, every year we celebrate CA Day on 1st of July. With this, I now call upon our chairperson, CA Ajay Kumar, to share some of his thoughts with us today. Over to you, CA Ajay.
Respected Chief Guest, Your Excellency Piyush Srivastavaji, Ambassador of India to Bahrain. Respected guests of honor, CA Nihar Jambusaria, President of ICAI, CA Dr. Debashish Mitra, Vice President, other dignitaries present, fellow chartered accountants from Bahrain and overseas, and other invited guests, a warm good evening to all of you. Let me start by wishing you a happy 73rd Chartered Accountants Day, which we are celebrating on the 1st of July. We also dedicated this event to the India at 75 celebrations, which the Bahrain chapter has been involved under the guidance of the Indian Embassy. I'm pleased to welcome to this event Your Excellency Piyush Srivastavaji. Big thank you for joining us today in our CA Day celebration. Piyush ji had come to Bahrain last August, around the same time that the new committee took office. The amount of work he and his team has done during this pandemic period has been really amazing. At BCICI, we really appreciate these efforts and extend my sincere gratitude to him for all the support we have been receiving from the Indian Embassy, whether it is in terms of our events, conduct of the CA examinations, which of course again start from Monday, for the CSR related support, which was extended during the second wave of COVID, in which we also could play a part by contributing to the sending of the oxygen cylinders, celebrating last month as yoga at every home, and many more activities. Your Excellency, as the patron of the Bahrain chapter of ICI, you've always been accessible, supportive, and been a guiding force. Thank you for that, and we look forward towards your support and guidance in the coming year as well, as we tackle some important topics such as the CA qualification recognition and our registration. So thank you again, and I look forward to hearing from you. I'm also pleased to welcome our dear President, CA Nihar Jambusaria ji, one of the few presidents who is from the industry. He has been very close to the issues of the members in the industry, which is what majority of the Bahrain members and overseas chapter members are. And this has helped in bringing a lot of initiatives, to look into their needs, such as upskilling and reskilling. As a true leader, you've displayed that listening is important, and this was evidenced when you
We lost your audio.
who has been standing shoulder to shoulder with our president, sir, in leading the ICI in these tough times. And looking at him, we are assured that the profession is going to be safe hands in the future as well. At the Bahrain chapter, we stress a lot on commitment, and our leaders displayed this when they chose to participate in our first GCC joint celebrations that were held on 1st of July from their car on the way back from an important meeting. Their presence today is also another testimony of the commitment to remain close to the overseas members. We look forward to hearing from both of you, sirs. I am into the last month as the chairperson of Bahrain chapter of ICI, and we have a new team ready to lead the chapter from the 1st of August under the able leadership of CA Santosh. My term was focused on 7 key objectives, namely value addition, particularly focusing on upskilling and reskilling, sustainability of the chapter, optimum utilization of resources, inclusiveness of chapter members in activities, collaboration with others and the CSR activities, enhanced use of technology, health and well-being of the members and their families. I hope I have been, with my team, able to deliver on these objectives. Of course, it is motivating when the efforts are recognized. I'm very thankful to our parent body for recognizing our efforts with the first prize in the Best Overseas Chapter Awards in Category 2 for the year 2020, which will cover the term of my predecessor, CA Mahesh Kumar, and my term. I'm sure the incoming committee will put in their best to bring glory to the profession, as well as act as a partner in nation building, both for our motherland, India, and our second home in Bahrain. I thank CA Clifford, the senior most member in my team, for taking up the role of the Master of Ceremony in today's important event. And with that, I wish you a fantastic seminar ahead, and I hand back the control to CA Clifford.
Thank you, CA Ajay. May I request our chief guest, Your Excellency Piyush Srivastava, to say a few words. Over to you, sir.
Thank you and very good afternoon. Am I audible? Okay.
Yes.
CA Mr. Nihar Jambusaria, CA Dr. Debashish Mitra, Vice President of ICCI, Mr. Nihar, the President of ICAI, CA Ajay Kumar, Chairperson of Bahrain Chapter of ICAI, members of the Bahrain Chapter of ICAI, and distinguished guests present here today. Let me begin by congratulating you all on the occasion of the 73rd Chartered Accountants Day, the day which we are celebrating today. Indian Chartered Accountants are recognized worldwide for their high standards of professionalism and as being among the best and brightest in the profession. And Bahrain is no exception. Honorable Prime Minister Shri Narendra Modi, in his wishes on CA Day, mentioned that CA fraternity has a vital role in India's progress and called upon all chartered accountants to keep the focus on excellence so that Indian firms emerge as one of the best globally. It is in recognition of ICAI's crucial role in India's economic diplomacy and outreach and in promotion of India's trade and investment ties with the countries worldwide that the government of India has recently given it a status of Apex Trade and Industry Association. I would particularly like to commend the Bahrain chapter of Chartered Accountants of India, an organized professional body of Indians in Bahrain. Our chartered accountants in Bahrain are very well regarded by the government and industries in Bahrain. They are present in virtually all sectors of economy. Their contribution to business and economic development in Bahrain, as well as in promoting bilateral trade and investment ties, are noteworthy. Bahrain chapter of ICAI has also been very active in organizing various socio-cultural events focusing on projecting India's industrial, technological, and scientific progress, as well as its vibrant cultural diversity. This year, despite COVID-19 challenges, they have partnered with the embassy in organizing program for International Day of Yoga 2021 celebrations, as well as celebrations of Women's Day, with overwhelming participation from local Bahraini as well as Indian community. Bahrain chapter of ICAI is celebrating this year's CA Day events as part of India at 75 celebrations. As you all may be aware that we have started this celebrations of India at 75, which the 75th anniversary we will celebrate in next year on 15th August. But we have started celebrations to celebrate 75 years of our independence and the glorious history of our people, culture, and achievements. This year, being the Golden Jubilee year, is also the landmark year in the journey of bilateral relations between India and Kingdom of Bahrain. I look forward to celebrate both these major events in collaboration with our Indian associations, including the events focusing on trade and economic sectors, as well as the cultural events in collaboration with BC ICAI. India and Kingdom of Bahrain, sorry, I think there was some disturbance. India and Kingdom of Bahrain have trade and people-to-people connect dating back to centuries, to the period of Indus Valley and Dilmun civilizations. Our bilateral relations have strengthened and diversified over the years. You, the members of our vibrant CA fraternity, play a very important role in advancing our bilateral trade and economic ties, and further strengthening the existing goodwill between our two countries. I once again convey my best wishes and greetings to Bahrain chapter of Institute of Chartered Accountants of India, and in fact all the chartered accountants of our country on the occasion of National Chartered Accountant Day. All the best. Thank you.
Thank you very much, sir, for a wonderful words of wisdom. Dear members, we received just now the message that our president of ICAI, CA Nihar Jamurasia, he is not keeping well, so he won't be joining us today. With this, I now request our guest of honor, CA Devashish Mitra, ICAI Vice President, to say some few words to our members. Over to you, sir.
Thank you very much. Good evening from India to all of you, and good afternoon to all of you. My heartfelt congratulations to the Bahrain chapter for organizing this program, celebrating the CA Day. My heartiest thanks to His Excellency Piyush Srivastavji for his kind presence amidst us this afternoon. And of course, the team led by C. Ajay Kumar, the chairperson of the Bahrain chapter, and everybody else. Hearty congratulations on the 73rd CA Foundation Day, which we celebrated yesterday. Let me tell you, His Excellency was speaking to us about the 75th year of Indian independence and how we are going to celebrate that from now on. Just going a bit, just post-independence on the 1st of July 1949, the Institute of Chartered Accountants of India was set up under an Act of Parliament. The founding fathers of the nation, deemed it fit that the institute comes into existence and the profession also the profession gets ready to serve the nation even before India became a republic. Since the time of 1949, we have grown and we have spread our wings in beyond the frontiers of India. Today, we have 42 chapters, overseas chapters, 26 representative offices, and our presence is there in 45 countries of the world. Bahrain chapter is a very important chapter, amongst the overseas chapters that we have. Yesterday, when we were celebrating the Foundation Day, we had two honorable ministers present amidst us. In the morning, we had Arjun Ram Meghwalji, Union Minister. He came and inaugurated a very important social project of the institute. That is, planting 10 lakhs trees, throughout the country. And he was effusive in his praise for this, social related activities of the institute. Over a period of time, we have really spread beyond our core areas of accounts, tax, and audit, and gone into these kind of areas where we want to be socially relevant. Post the visit of Meghwalji, in the evening at 4:30, those of us who followed the program, there were about 77,000 chartered accountants following our program. We had Piyush Goyalji amidst us, and following Piyush Goyalji's address was Harish Salve addressing us from London, and of course, Mr. Ella, the CMD of Bharat Biotech, which has developed the Covaxin. And let me tell you, CA Piyush Goyal, he is a member of the institute and of course a rank holder too, was again extremely appreciative of the efforts of the Institute and the way we have grown since 1949. Today, the Institute is trying its best to make the members aware that there is great professional opportunities in areas which may not be part of the beaten track. For example, the Institute is telling the members that technological developments will be immense, and there is great opportunity in areas like artificial intelligence, blockchain, data and analytics, and cyber security. We are telling the membership, and we are doing everything possible to bring the membership conversant with these changes. At the Institute, we are developing this audit tools and trying to circulate this amongst the membership free of cost. So one more area of this integrated reporting, since many of you are in service, you'll be aware, integrated reporting also is a very important area. In India, SEBI has mandated that business reporting, business responsibility reporting be made recommendatory for 1,000 top listed companies. So in India, we are doing a lot of work on this social responsibility standards, sustainability responsibility standards. And we are hoping that in the process, we continue to be relevant in areas which are, as I said, a bit away from the usual areas. All of us chartered accountants, we are very much aware of the 1P, that is the profit. And that has been something which has driven us in the sense that we have seen the balance sheet, the financial statements, and relied on the profit or loss. But now the Institute is trying to take the membership to two other P's, that is the planet and the people. So to the Institute now, we have not only one bottom line, but we have three bottom lines, that is profit, people, and planet. So we are doing everything possible to make the membership aware of the recent changes and be relevant and continue to be a partner in nation building. Let me tell all the membership who are listening to me that the three words, independence, integrity, and excellence, are still words of great importance in the corridors of the Institute of Chartered Accountants of India. And yesterday, CA Piyush Goyal was saying that ICAI, when he was talking about, he coined 4 words to define ICAI. He was saying that I should stand for integrity, C for commitment, A for accountability, and I for intellect. And these are words that people associate with the Institute. I once again thank His Excellency for his kind words about the profession. The Honorable Prime Minister also, has spoken very highly of the profession in a letter addressed to the President. And we are committed to serving the nation, because to the profession and to the Institute, it is always nation first. I congratulate the Bahrain chapter for organizing this program, and I have no doubt that the membership will get full benefit from the technical discussion that takes place post the celebration, that is on IFRS, because that is one area the Institute has been working very, very hard. We have 39 Indias in India, about 7 carve-outs from the IFRS, and I'm sure in the quiz that you are having, the members, the Bahrain chapter members and the other members from the Middle East who are joining your program will learn that much more about IFRS as well as Indias. With these words, I once again congratulate the chapter for organizing this and for having invited me to be present. Thank you very much.
Thank you, sir, for the wonderful words of wisdom to our members. Dear members, now with the permission of our dignitaries present, we will now proceed with the virtual CA flag hoisting and the cake cutting for CA Day celebrations.
य एषः सुप्तेषु जाग्रति य एषः सुप्तेषु जाग्रति कामं 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 कामपुरुषो पुरुषो निर्विमाणः निर्विमाणः तदेव शुक्रं तद्ब्रह्मा तद्ब्रह्मा तदेवामृतमुच्यते तस्मिन् लोकः शतः सर्वे तदूनाद्यकश्चन एतद्द्वैता 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 एतद्द्वैता
So it is quite unfortunate that our President Sir could not join us today, but I think with the permission of His Excellency and our Vice President Sir Debashish Sir, I think we will just do a ceremonial cake cutting. I think this is just to celebrate the CA Day. I think only CA Clifford is the only person that I can feed him to, but still. Thank you. I'll just with your permission, sir.
Mr. Chairman, if I may butt in, the President is quite unwell, so I'm sure, he gives the good wishes to all of you.
Thank you, and over to CA Clifford.
Thank you. Now I will request our chairperson, CA Ajay Kumar, to announce the contribution by Bahrain chapter of ICAI to CA Benevolent Fund.
Thank you, Clifford ji, again. So the idea was we had conducted some events yesterday so that we could raise some contribution towards the CA Benevolent Fund, which serves to support the chartered accountants and their families in India for their, who are facing the financial difficulties and other things. So we wanted to make it a very inclusive event. As I mentioned before, inclusiveness is part of our objective that we have been working on. So to make it an inclusive event, we had actually given 3 options to our members. So the first one, in line with our India at 75 objective, we had done a Padayatra. So we called it a CABF Padayatra, and where we had requested members to walk in the safety of their, wherever they are in respecting the protocols for COVID, and they could walk and they could send us a picture of the kilometers that they have walked. And for each kilometer that the members have walked, we were contributing 1 dinar to the CA Benevolent Fund. So this was option 1. The option 2 was, of course, members could come forward voluntarily to contribute funds from their own perspective. And the 3 was, we have something called a commitment program, which members earn for. It's like a loyalty program where members earn points for every event that they attend. And some of the members have good number of points. We said anybody who's contributing in terms of commitment points, we will again contribute 1 dinar for every 1,000 points that are being contributed. So now all these put together, I think we reached very close to around 900 dinars is the total contribution that we have raised. So I think that works out approximately 1.8 lakhs. I think the chapter will now round it off to. So I'm very happy to announce that the Bahrain chapter of ICAI will be contributing a total of 2 lakh rupees to the CA Benevolent Fund. account, which we will be transferring to the ICA chapter account, ICA, the main account, parent body account. So I thank all the members who came forward. I think this is the spirit of participation that they showed. And we hope that they will be further encourage everybody to contribute voluntarily even more. But this is a very small token of this token gesture from our side, which we thought we should give. So thank you so much again.
Thank you, CA Ajay. Bahrain chapter of ICAI have many great personalities. Chapter have selected few ambassadors who have done a great achievement to BC ICAI members, going out of the way and doing great things. For this, I would like to call upon our chairperson, CA Ajay Kumar, to announce the award.
Thank you, CA Clifford ji. Dear members, I think at the beginning of the term, we had instituted a BCICI Ambassadors Award. It was meant to be something to recognize our members who have been doing a lot, which has been benefiting the members on a consistent and regular basis. Of course, to start off, I think we were in the middle of a pandemic. I think one of the most important thing that we needed at that point in time was to ensure that the well-being and the fitness of the members was maintained. So I think we had such a nice icon to start off the Ambassador Award, which is CA Ronak Desai. CA Ronak had initiated a group, WhatsApp group, where most of the members and their families had joined. They were participating in activities which were conducted very innovative manner, people where they could do it from their home, at the same time benefiting and motivating each other. So this has now grown into such a big movement. We call it the Tadipar movement at the moment, where it's not only the members of the BCICI, but also a lot of non-members who are also joining and participating from this over. So this has basically become a fitness movement that he is spearheading. And it is my pleasure to welcome the very first recipient of the BCICI Ambassadors Award, CA Ronak Desai. Please put your hands together for CA Ronak. So this is the very first award for CA Ronak. I would probably now request CA Ronak to say a few words.
Thank you, CA Ajay, for this fantastic honor and award for recognizing the fitness movement. But this award does not belong to an individual. It belongs to the entire CA fraternity of Bahrain. And that entire credit for this award goes to two things. One is our CA profession, because the profession has given us the ability to think that nothing is impossible. And when you see a chartered accountant, you see a good chartered accountant. But when you see a chartered accountant and expect them to be a good marathon runner, then it is a challenge for chartered accountants. And the entire fraternity of Bahrain, the CA fraternity, took this challenge hands-on. They came together and worked for their fitness. And today, there are many marathon runners, there are fitness enthusiasts. This award belongs to them. And the second credit goes to CA Ajay, because a chartered accountant can be a chartered accountant, but may or may not be a good cricketer. But in CA Ajay, we have a fantastic cricketer, and that is why he was able to recognize immediately that this platform has to be developed to recognize and help recognize all members in her potential. And thanks to his efforts and his recognitions like this, that these efforts are being recognized. And thanks for providing such a platform for all the members.
Thank you.
Thank you, all of you. Thank you.
Thank you, CA Ronak. Thank you. I'm now happy to invite the second winner of the BCICI Ambassador Award, CA Jonathan D'Souza. He is being awarded this award in recognition for his outstanding contributions to the BCICI fraternity by spearheading the environment protection and awareness among the BCICI members and their families. The launch of the BCICI Earth Warriors Group has been instrumental in spreading awareness among the BCICI fraternity. Of course, this is also a recognition for his better half and our dear ExCom member, CA Rowana Miranda, and his parents, who have been equally contributing towards this effort. It is my pleasure to welcome CA Jonathan D'Souza. Please put your hands together for CA Jonathan. So here you go. Now, probably I would request CA Jonathan to say a few words.
Sure. Thank you, CA Ajay. And good evening, fellow members and respected dignitaries. Our planet is currently facing many human-made crises, such as global warming, plastic pollution, and loss of biodiversity. At times like this, we tend to think that the big problems can only be tackled by countries or governments. But we underestimate our power as individuals. So keeping this in mind, I had decided that along with the support of my loving family, to start spreading the message of no action is too small, the power of one. It was at this point that the chairman, CA Ajay, firstly conceptualized the CSR committee at the beginning of his term, and he requested me to join, and the movement just took off from there. I would like to dedicate this award to my loving wife and my parents for all the support. And of course, to each and every member of the Earth Warriors group who gave up their valuable time to join me and support this cause. Thank you once again. Thank you, everyone. Thank you.
And now to announce the third and probably the final awardee in my team's term. He is somebody who's my close friend, who's been there for closely associated with all the sporting activities that we have been doing from the BCICA perspective for the many years now. But there's a side for him which not many people knew, which was about his passion for doing CSR activity. In 2018, he created a group of like-minded professionals, mostly belonging from the BCICA fraternity, who were coming together and contributing for the cause of the less privileged persons in the society, people, our friends who are living in the labor camp and other areas. And this now has grown into a movement, which is often very closely working with a community association like the Indian Community Relief Fund. So it is my pleasure to welcome the third recipient of the BCICA Ambassador Award, CA Vinod Rathi. Please put your hands together for CA Vinod Rathi. I would now request CA Vinod to maybe say a few words.
Good evening, members, ExCom, and all respected dignitaries. Serving the society. This is one of my passion, which I am pursuing since my school days, which actually came in inheritance from my parents and grandparents. I have seen them doing such activities in my childhood, and I was very motivated to do the same. Also, with the God grace in my school days, I got such a wonderful friends who have similar thoughts to serve the society. So in 2008, we friends formed the NGO named Helping Hands for Humanity, which is actively organizing a blood donation camps in India. And so far, we have conducted more than 100 blood donation camps. Apart from these blood donations, we also serve orphanage childs, old age home people in India. Now, after coming to Bahrain, as I said, this is my passion. So I want to continue the same in Bahrain. So initially I was doing at a personal level, but in 2018, as Ajay mentioned, that we formed this group called Manav Dham in Bahrain, where we have a group of friends. They are supporting underprivileged people, and we are providing them the food, and also we are supporting ICRF for their social cause. Actually, how this idea was arrived. So in 2018, in our office, I was discussing similar thought with my colleagues, my ex-boss Nilesh, and colleague and a fellow CA member Angelika, because their intention was also to helping the poor people. And that time there was a lot of cases we are hearing that people are not getting salaries, they are not able to procure their food. So then this idea came and we formed this group. We have more than 60 people in this group who is monthly contributing money to support this cause. So basically this award goes to all those people. I am just a coordinator. I coordinate all these activity, but actual support come from them. And now to pursue my passion better, I got this opportunity to be part of CSR committee this year, which is a very unique concept introduced by our chairperson, Ajay Kumar. So I'm very much thankful to our chairperson, Ajay Kumar, and other ExCom member for giving me this opportunity and now the honor of and this award. So very thanks to you, the team. And I would also like to thank the Lord Almighty, my wife, my family, and all my friends who are supporting me during this journey. Once again, thank you for the award. Thanks.
So with that, I think we conclude the BCICI Award, Ambassador Award ceremony. I will hand back the control to CA Clifford D'Souza to take the session forward. Thank you.
Thank you, CA Ajay. With this, we conclude our CA Day celebrations. But of course, our technical session will begin now. So due to some commitments, our guest of honor and our chief guest will be taking the exit. And we thank you for coming and joining us in this event. On this great occasion of CA Day, what better topic we can have other than IFRS, which is very close to our heart. As it is said, we breathe, we eat, and we drink IFRS in our day-to-day professional life. Today, we have with us energetic and dynamic speaker who will take us through the IFRS in a fun and interactive manner by conducting a quiz on IFRS and also explaining the concepts along with it. He is an associate member of the ICAI and has been working in the Middle East for the last 19 years. His overall experience in the audit and accounting domain spans over 23 years, including with his work experience in India. He has been a practitioner all his professional life and a strong advocate for promoting professional standards, including IFRS and international auditing standards, which also have remained his area of specialization for his firm. He is an experienced partner with KPMG Bahrain and leads their financial services practice, which covers a host of audit and advisory services to the banking and capital market clients. He also heads the firm's Department of Professional Practice, which is responsible for forming technical views and providing guidance to professionals in audit and accounting. He was one of the youngest partners promoted by an international accounting firm at the age of 30 and represents the next generation of leadership in the profession at a global level. He is a regular speaker at various professional events on topics of IFRS, banking regulations, and risk management, and has also contributed to many KPMG global and regional publications on a wide range of topics. His other dimension, he is a cricket enthusiast and loves spending time with his two daughters. He used to play guitar in a rock band in his college days and has done stage shows before he has found his footing with the profession. Please help me to welcome CA Mahesh Balasubramanian.
Yeah, thank you very much, CA Clifford, and I'm very excited to be with our fraternity and my colleagues in Bahrain to host our IFRS quiz. In line with our profession, while we are celebrating CA Day, we would not leave out the technical topics, and we are using this forum to make sure we engage in some good and exciting quiz. Like CA Clifford mentioned, IFRS is a topic which is very close to us. It is fundamentally part of our role in our day-to-day lives. But it would be good to see, how we reflect on it on different areas and look at that. But before I start the quiz, I would want to thank CA Ajay and his executive team for a fantastic task. I've been witness to the amount of effort that goes behind in conducting an event like this. So on behalf of all the members, while I stand in the studio, I would want to probably give a big round of applause to CA Ajay and his executive team to putting an event like this together. And lastly, thank you for giving me this opportunity to present with my fellow colleagues. So we talk about IFRS today, but before getting into that, I would like to maybe get into a short presentation on a topic which CA Jonathan D'Souza spoke about. And in a few previous seminars, we've been talking about topics such as ESG and climate change. So before we get into the IFRS quiz, I probably want to spend a little bit of time on this topic on IFRS or financial reporting and climate change. So is this just a global topic, or does it have any relevance to our role as chartered accountants or people involved in the financial reporting profession? So when we talk about climate change, is it a futuristic topic? Is it something that is relevant today? And is this something that needs all our time and attention and focus as we look at what is evolving over the next 12 months? So let me maybe talk about some key highlights or headlines that have come through over the last 12 months on this topic of climate change and financial reporting. So if you look at these headlines, about $210 billion of damage in 2020 were purely coming out of the cost of climate change. Of that, a significant portion came from Southeast Asia and emerging economies, of which a very small portion was actually insured, which means the financial system and the economy has actually absorbed a lot more losses than what it could handle from these climate changes. Bringing it a bit more closer to accounting and reporting, Total, when we look at Total, takes 8 billion right down. This is Total Group. We all have heard about the French oil and gas conglomerate. In their 2020 financial statements, they have actually written down assets worth $8 billion, which were carbon heavy. And the future of these assets are completely going to be different with changing regulations. So this has come very close to the process where you are now seeing impairment losses and write-offs that are coming through in the financial statements. Global reinsurers like Swiss Re are predicting that about 18% of the GDP will be lost because of climate change related issues if no action is taken. And if you look at the multilateral development banks like World Bank and all the large international multilateral development banks, they are very clear in their process and philosophy that the next round of financing and support is largely focused on climate change related projects and largely focused on emerging economies and countries which are most affected by climate change and at the same time would benefit the most by investments which would be more neutral towards carbon and climate change. So this sets the context of why this topic is important. It is real. It is on the top of the agenda on sustainable development goals at the UN. It is on the top of agenda for most political conversations at a global level, and is also coming at the top of agenda of our standard setters when you look at financial reporting. So I have some common issues that have the potential of impacting financial statements. So if we run through this list of questions, and if we feel our organization either today or in the future would be getting impacted through these set of questions, then definitely climate change has a very significant and direct impact on our financial reporting. So let's look at what our standard setters are focusing on and what are some areas which would be interesting for us to look at from a climate change standpoint. So if we come closer to home, our own capital markets regulator, the Bahrain Bourse, has issued ESG corporate governance guidelines. We expect a lot of corporates to start reporting their ESG impact and activity in their annual report going forward. Our global standard setters like FASB, which sets US GAAP, and ISB, which is the regulator drafting IFRS standards, and Basel Committee for Banking Supervision, which is largely issuing guidelines for financial institutions. All of them have this on the top of their agenda, and this is a key topic emerging for risk discussions in boardrooms as well. We have seen a significant increase on the focus on these topics over the last year in 2020, where roundtable topics have emerged. We are seeing drafts coming through 2021, and by 2022 or 2023, we expect these to be very clear financial reporting standards, where all of us collectively, we have a sizable responsibility to see how this gets implemented. So let's talk about a few areas for consideration when we talk about this important subject of climate change. So ISB issued a paper last year when they were deliberating this topic, and they identified a host of topics that would be impacted by climate change. So all our current standards, the way they are written, would be affected by this topic in many different ways. So if we start with different components of our financial statements, we have assets, we have items such as PPE or intangible assets that are more futuristic and depend on future cash flows from these assets to sustain its current carrying value. So like we looked at the example of Total Group, when they made a futuristic assessment of what would these carbon assets or pollutant assets would generate in the future, obviously their expectations from last year to this year has significantly changed. So when you put this in the form of future cash flows or future economic benefits that would come from these assets, there is a significant change which could lead to impairment or write down or fair value changes in the carrying value of those assets. If you look at liabilities, we expect a host of regulatory changes that would force entities to look at environmental and decommissioning liabilities. We'll need to look at how do we deal with emission or green bond related elements in our funding strategy going forward. And from an insurance sector standpoint, we saw the statement of Swiss Re. We'll also need to look at how insurance risk will now be measured differently because of the impact of climate risk. So there are many areas of liabilities that would get impacted, be it contractual, be it regulatory, or coming from the change in strategy from government in how industries or businesses should operate going forward. If you move on to lenders, you would have seen a lot of announcements by large global banks and many of our local and regional banks also on them adopting ESG and climate change as a measure of lending going forward. So we have also seen the rise in issuance of green bonds. We have seen the rise in issuance of funding which have ESG related commitments. And at the same time, lenders are also very focused on reflecting pricing based on their assessment on ESG. So put in simple terms, if your projects are going to be sustainable and they're going to be friendly to the overall ESG agenda, the wider ecosystem, be it the government in the form of tax credits or the lenders in the form of beneficial interest rates, would be supporting your projects. And if you're part of an industry which is not going towards carbon neutrality, which is not supporting the overall green agenda, you're probably going to see a change in the way you're going to be charged for cost of capital and cost of funds. From the standpoint of a borrower, significant amount of green bonds are being issued. There are loads of accounting issues which you need to consider. For example, the way a typical green bond structure works is you make a commitment of going carbon neutral and you make a commitment for investing into particular ESG projects. If you don't achieve that by a particular point in time, the rates would be stepped up. If you achieve that and if you do more than what was promised, you will be getting a lower reduction in your rates. So from an accounting standpoint, we're dealing with significant questions like, is this an embedded derivative? How do we price this into our accrual arrangement? And how do we actually reflect these things on our financial statements? And last but not the least, the ESG disclosures are all about our transition to a more carbon neutral ecosystem, to a more carbon neutral operating environment. And our financial statements eventually would be a mirror for those disclosures. What is expected of the carbon from the financial statements is that we start disclosing our KPIs, what we are tracking, where we are in our journey, and how we are achieving sustainability through the period of time. So from a IFRS reporting standpoint, this is a big area of change. As this is on the global agenda, this is something which is real, which is important. I think we also have a role to play where we see how this synergizes with our ecosystem on financial reporting and how we play our role within our own organizations to make sure that there is clear, transparent reporting on our journey towards achieving net carbon neutrality. So with that, I just wanted to bring this topic because it's a significant development and you're going to see a lot of guidance that is going to be issued over the next 12 to 18 months. And this is a new topic which all of us would need to familiarize ourselves as our requirement of our profession and also as part of our contribution and support to this very important subject. With that, we'll probably now move on to starting off our quiz for today. So I kept this quiz a bit mixed up, so it doesn't follow a particular structure or a flow of topics. It's a mix of questions which we've seen in our day-to-day dealings with financials, some new topics, but it will be interesting to see how we collectively kind of answer those questions. So we have in total about 50 questions, which will be running through the session for the next hour. And what I'll do after each question is try and explain a little bit of background on what the answer is or what the current thinking behind this topic is. So what you have on your screen now is the game pin. I hope all of you have your devices ready and have registered. Yeah. So the preferred way to look at this is your first name and the membership number, like we have CA Mahesh is coming on screen and other participants joining. So we'll give everybody a chance to log in. So while we are having everybody logging, the institute has decided that the top 5 scorers are definitely getting a prize, but the bottom 10 may have to write the exams all over again, possibly. And not only the bottom 10, anybody who logs off from this point in time will be tracked for re-examination possibly. I have Ajay tracking this very closely with his 3 computers next to him. Yeah. We'll probably wait for 2 more minutes to see if we have more of our members logging in. So like we said, we have about 50 questions for all of you today. So we are wondering why we have 98 people who have logged in for the session and only 39 registered so far.
Because of rewriting the exams.
That's the only reason.
I think we are seeing some of the names without the membership number. It will be difficult if people have common names. So maybe request our members to make sure that they also put in their membership number either before or after their names, please. Okay, in another 30 seconds, we'll probably start off the quiz. All right, we do the countdown now and we start in 5, 4, 3, 2, 1. Let's start off. Let the games begin. Out as its own countdown. So the first question, in what circumstances can gain or loss on equity instruments carried at fair value be dealt with in other comprehensive income? We have 20 seconds for you to pick the right answer. So we started with the easier ones. Let's see how many of you have had your afternoon tea and evening snack. Okay. We got 15 of the participants getting the right answer. So,
but no option appearing.
Under IFRS 9 now, so the question was focused on equity instruments. Equity instruments can be classified at fair value through other comprehensive income only if they are not held in a trading book or they have not been designated at fair value through profit or loss. So no other choice or option is actually available. So if you remember in IS 39, AFS used to be the residual category. Under IFRS 9, FETPL is the residual category. So you have to make an irrevocable election to classify an instrument as FEOCI, and it should not be FETPL or trading. And then you get that answer. We move on to the next question. Which of the following, if included in pricing of a financial instrument, would result in failure of the SPPI test? So the SPPI test is part of IFRS 9, which is critical for you to get to a amortized cost classification for debt instruments or for FEOCI debt instruments which are not equity. Okay, the right answer is conversion feature. So the typical component, so SPPI is solely payment of principal and interest. So anything that is not reflective of interest is the optionality feature which does not meet the SPPI requirement. So a conversion feature, conversion to an equity option is not a traditional component of interest. So if you have that as a feature, you would not comply with SPPI test. This would mean that such instruments will have to be mandatorily measured as fair value through profit or loss. You will not get the option of measuring them at amortized cost or through the OCI. Moving on to the next question. So which of the following would not be included in the cost of a qualifying item of property, plant and equipment? So what costs will you capitalize within the cost of a property, plant and equipment, and what costs are not permissible to be capitalized? So this should be pretty straightforward. Like we expected, most of you have got it right. So a refundable value added tax is not part of cost of PPE because there's something that gets reimbursed or refunded. So it's not a direct cost that should form part of PPE. I think this was just an easy one. We'll move to the next one. So a material prior period error should be corrected. How do you correct a material prior period error? Do you go retrospective? Do you do it prospectively because it's not practicable to do so? You have a choice between retrospective and prospective, or you have to do it prospectively. Again, a majority of our participants have got it right. So prior period errors have to be corrected retrospectively so that the comparability of the financial statements is maintained. An error is a known fact. It is not a judgment. So you may not have an impracticable defense to not do it. So the general expectation under the standards is to do this retrospectively. Moving on. Come on, we need to dethrone CA Mahesh from his pole position. So a change in an accounting estimate should be accounted for. Similar choices, either retrospective or prospective. Retrospectively unless it is impracticable to do so, only retrospectively or only prospectively. A slight variation to the previous question. So let's see. Okay, we are now getting people more and more awake. They're all reading the questions properly. Prospectively is the right answer. Estimates are for the current period. You don't reopen estimates of prior period. So you would always do that prospectively. Moving on to the next question. Goodwill does not fall within the IS 38 definition of intangible assets because it is not separable. It may not generate future economic benefits. It is a monetary asset or none of the above. So now we're going to mix up the questions a bit more. Okay, so I'm surprised a lot of you got it wrong because none of the above was a trick option. People like to select that. But goodwill is not recognized as an intangible asset because it is not separable. And if you don't meet the separability criteria, you don't get to the classification of an intangible asset. So just a quick reminder to all our colleagues that goodwill is a residual amount in acquisition after you allocate fair value of identifiable assets and liabilities. And what you're not able to allocate is identified as goodwill. Hence, it is not separable. It cannot be measured or looked at upon separately. A bit more on intangible assets. The revaluation model cannot be used for the measurement of an intangible asset because So we have options here. Is it about how you value it, when you value it, or the frequency of how much you value it, what is required? So again, we're getting a bit of, so intangible assets, generally, you don't get the revaluation model unless there is an active market for the type of asset. So it is more internally assessed asset or an acquired asset. So unless there is an active market, the standard does not allow you to fair value an intangible asset. So an impairment loss is an amount by which the carrying amount of an asset exceeds its market value, the carrying amount exceeds the recoverable amount exceeds the written down value, or the recoverable amount exceeds the carrying value. So it's a word jumble. All right, so 13 of you have got it right. Impairment is when the carrying value of an asset exceeds its recoverable amount. So you always compare the carrying value with your assessment of recoverable amount. The other measures are not a trigger for impairment. Moving on to our ninth question. So we talk about goodwill impairment testing. So what time of the year should we do a goodwill impairment testing? Do we do it at the beginning of the year? We are allowed to do it at any interim reporting period we would like to. We should only do it at the end of the reporting period because we need to disclose it, or we need to be consistent when we do it each year. Okay, again, a mixed bag of answers. So this is an important part of IS 36 on impairment. The standard requires you to make a goodwill assessment at the same point in time each year. It doesn't tell you to do it exactly at the end of the year only or end of the interim reporting period. So for example, if you do it October each year, they're saying you need to consistently do it because you're looking at future cash flow estimates. When you look at a goodwill, you're valuing the combined corporate assets with the cash generating units. So you need to be able to make consistent estimates at a similar time with a similar exercise, oversight, and management governance. So you would see many of the organizations normally do the goodwill impairment test after they formed up their 3-year or 5-year financial forecast. Some do it as part of their budgeting exercise end of the year, and some organizations finish it in an interim period, end of September or could be October. But the standard requires you to do it at the same time in each reporting period. Discontinued operations, IFRS 5, is defined as a component of an entity which has been disposed of or is being classified as held for sale, is expected to be disposed of within the next 12 months, only if it is classified as held for sale or something that has already been disposed of. What do you call a discontinuing operation? Okay, so a discontinuing operation need not be something that has already been disposed of. It has to be something that either has been disposed or has been classified as held for sale. Now we know the held for sale classification comes with certain criteria. I would not probably list that down because there are other questions around that. But one important distinction, a discontinued operation can be everything that is an asset held for sale need not be a discontinued operation, but everything that is a discontinuing operation will always be classified as held for sale. To give an example, if you have a large division across multiple geographies and you report the division as a segment, if you sell the assets of one segment, it is not a discontinuing operation, but the underlying assets could still be assets held for sale. So it has to kind of meet two dual criteria together. Moving on. I think Mahesh is taking a bigger gap. So the next question, if a non-current asset is to be abandoned, obviously we don't classify it as held for sale. What is the correct reason why we do not classify it as held for sale? So again, you're kind of a mix of options, but the correct answer or the right way to think about it, an abandoned asset is something that has been abandoned in continuing use. It is not something that is held for sale other than for continuing use. So IFRS 5 kicks in only when you discontinue your continuing use. But abandoned asset would either be accelerated down to its recoverable amount or residual value, or fully depreciated asset or fully provided for, but still be classified as asset held for continuing use and not as asset held for sale. So which of the following items cannot be included in the cost of inventories? Variable production overheads, cost of abnormal wastage, fixed production overheads, or irrecoverable import duties payable on the acquisition of inventories. Great, I think as expected, most of you have got it right. So the cost of abnormal wastage of material and labor is not considered a direct cost of inventories. It is a cost of inefficiency which is not loaded onto the capitalized cost of inventories. Everything else is accepted, whether it's fixed, variable, or irrecoverable duties and taxes. The next question. So IS 37 defines a provision as what? A liability which is not legally enforceable, a liability of uncertain timing or amount, or something that reduces the carrying value of an asset, or a liability which is legally enforceable and is being determined at the balance sheet date. So how does IAS 37 define a provision? Again, we kind of got it varied, but the right answer is it's a liability of uncertain amount or timing. So if you look at IAS 37, it look at both legal and other aspects of provisions. It's provision, it is not liability. If it was a financial liability, it would have been covered under IFRS 9. If it would have been a legal or contractual liability, it would have been covered under IFRS 9. But you're talking about a liability with uncertain timing or amount, liability arising potential legal cases, potential warranty obligations. These are all covered under IAS 37 as provision. So that is the focus of the definition within IAS 37. Moving on to the next question. So again, related to IAS 37, so should you recognize a provision in relation to future operating losses and onerous contracts? So the way the answer is either both are yes, one is no, or a combination thereof. So do you think we need to make a provision for future operating losses and onerous contracts? Which combination is the right combination? So we don't make provisions for future operating losses under IAS 37, but we are required to make provisions for an onerous contract. An onerous contract is a contract which, as you're performing or there are unperformed obligations under the contract, you know that it will lead to a loss, or you will not be recovering adequate amount of revenue to cover your expenses. So you are required to book a provision on onerous contracts. But future operating losses, it gets covered through a different way when you look at impairment of a non-financial asset or a cash generating unit or goodwill. That is where you consider future projections of operating losses. But in the balance sheet date, you don't take provisions of future operating losses. You only take provisions for known liabilities, or the definitions of provisions the way we have looked at. So a new standard, I know a lot of us don't deal with IAS 41. So IAS 41 deals with agricultural, agriculture produce. So which of the following shall IAS 41 be applied to? Bearer plants, agricultural produce at the time of harvest, land related to agriculture activity, or all of the above? Okay, again, you're falling for the all of the above option. That's easier to jump into. So no. So IAS 41, I'll spend a little bit of time because we feel that this doesn't apply to our part of the world, but you would be surprised that we have a few listed companies in Bahrain or in the region who actually apply this standard, our poultry producers or the chicken farm. So the first option, bearer plant, is not an agriculture activity because you're just using the plant to process the produce. It does not create a biological asset. So bearer plants normally get classified under IAS 16 and not IAS 41. Agriculture produce up to the point of harvest is something that is created through a biological or agricultural production activity. So that gets covered under IAS 41. Everything else does not fit in. So IAS 41 again is a unique standard. It provides some good guidance. One fundamental difference is it requires you to measure your inventory at the likely selling prices and not at cost, which is what you would expect under IAS 2. So the production of an egg, or the poultry farms who eventually sell chicken, or where you have farms that are taking care of cattle and other things, they are largely focused on this kind of accounting. So it's an interesting standard. If you have time, I would recommend you definitely read that, because this is one part we consider out of syllabus all the time. So which of the following is not a characteristics of cash and cash equivalents as defined under IAS 7? So this is in the context of statement of cash flows. An investment which is readily convertible to known amount of cash, something that is subject to changes in value, a very short-term investment, and a highly liquid investment, which is not a characteristics of a cash equivalent as defined by IAS 7. Yes, most of you have got it right. It is something that is subject to significant change in value. For example, if you have listed shares, they are highly liquid, can be sold in the market the next day morning, but we don't classify them as cash and cash equivalents because they are subject to a significant risk of changes in value. But we hold government treasury bills. They are highly liquid, but they are not subject to significant changes in value, so they get classified as cash and cash equivalents. Moving on. Again, sticking to the statement of cash flow. So which of the following is either a cash inflow or outflow from investing activities? If you repay cash to lenders, you sell your bonds, you receive cash from issuance of debt securities, or you receive royalties under contractual arrangements. Which of the following would be investing activities? So again, most of you have got it right. So your sale of bonds is typically part of your investment activities. So if you're getting cash flows from selling bonds, that would be classified as investing activities. But you repaying cash to your lenders or you receiving cash from issuing new debt securities, these are all part of your financing activities, and royalties received would typically be part of your operating activities. Again, sticking on to cash flows, which of these would be arising from operating activities would not include payment to employees, cash receipts on sale of goods and services, cash receipts from sale of property, plant and equipment, and cash payment to suppliers. This should be a straightforward one. Spot on. So we are on the 19th question now. So again, a relevant new topic. When terms of a liability change due to transition from LIBOR to a new benchmark rate, which of the following would be true? Modification accounting applies. You will have to discontinue your existing hedge relationships. You continue your hedge accounting with the new prospective testing with revised terms, or all of the above would be true. Again, this was a mix. So this is a very relevant topic. I'll probably take a few seconds to try and talk about it. So normally, so you all know that LIBOR is being discontinued and it is going to be replaced by new reference rates. So for US dollar, you have something called SOFR. For the British pounds, you have something called SONIA. For euro, you've got something called Ester. So we are going to move into a new benchmark rate environment from end of next year. Again, they are very different timelines. So what this means is most of our existing contracts that would go beyond the transition period would have modifications. You will have changes in terms, which would lead to a revised credit spread and a revised benchmark spread. Now, in normal terms, this would trigger modification accounting because you are changing your credit spread fundamentally. So even qualitatively, this would be new set of terms as compared to the previous contract. Hedge accounting is all about making prospective cash flow assessment to see whether the prospective cash flows are effective. Here again, your underlying is significantly changing. So in normal times, both of this would be true. You would have applied modification accounting, possibly leading to a de-recognition and recognition of gains or loss because of modification accounting. You would have to discontinue hedge accounting, leading to cash flow hedge reserves coming into your P&L and new hedges being designated. But ISB, as part of its phase 1 and phase 2 amendments, specifically allowed this as an exemption to normal accounting rules for hedge accounting and for financial instrument accounting, saying this is a huge change which is industry-wide. This is a benchmark change. And when you came up with hedge accounting, you were actually doing hedge accounting for a benchmark change. You're not necessarily doing it only for LIBOR. So they have come up with special reliefs and transition rules which are allowing you to ignore the normal concepts of IFRS 9. So the third option is, which is something that is after the exemptions from ISB. But assuming the exemptions from ISB didn't exist, option 1 or 2 would probably be the right direction to think within IFRS 9. Moving on. So we are all seeing a lot of inflation and hyperinflation happening around the world. So what is one of the perceived weaknesses of historical cost accounting at the times of inflation? Your holding gains of inventories are not identified. Monetary assets are not reflected appropriately in the financial position. Depreciation charges are overstated, or you think profits are understated. So the first answer, which is your holding of inventories, holding gains on inventories is not identified, because in an inflationary environment, the selling price of inventories are expected to go higher, whereas cost would be more of historical or weighted average. The other components, don't get adjusted for inflation accounting. If it's a financial instrument, at fair value, the statement of financial position would reflect any adjustments in market yields. Your profits are not over or understated because of inflation alone. It is a combination of multiple other aspects. Moving on to the next question. Okay, some stocks are gaining, some market leaders are holding their position. We haven't reached midway till now, but the next question. So this is in the context of consolidated financial statements. So which of the following are not examples of intragroup balances? What this would mean is which one of these you would not eliminate as an intragroup balance when you do consolidation? So I think most of you have got it right. So everything else is a receivable or a payable or due from or due to between the parent and the subsidiary or a fellow subsidiary. So in the consolidated financials, it would get eliminated as intragroup transactions. But if you have a receivable from your shareholder, it's a related party transaction. It doesn't get eliminated. It will not be deemed an intragroup transaction or a balance from the context of the consolidated financial statements. Moving on. So again, a consolidation question. The amount of profit attributable to non-controlling interest in a 90% subsidiary would be what? It's 10% of the group profits before tax, 10% of the subsidiary's profit after tax, 10% of the subsidiary's profit before tax, or 10% of the group's profit after tax. How would you reflect the share of NCI in the profit? So option 2 is right, because when you look at NCI, it has got nothing to do with how you earn profits in the rest of the group. You own 90% in that subsidiary, so you would attribute 10% of the subsidiary's profit after tax to the non-controlling interest, and the rest of it would belong to the shareholders of the parent. It's a net result after tax, so you don't look at NCI as a measure before tax. Okay, we've got somebody who's taken pole position and beaten Mahesh before we reach midpoint. So good luck, Rajesh.
Mahesh, please unmute yourself because a lot of disturbances. I muted all. Mahesh, please unmute
Mahesh is
yourself.
on mute, I think. The quiz master.
Mahesh, you are on mute. Mahesh, you are on mute.
Okay. Which of the following are excluded from ECL requirements of IFRS 9? Expected credit losses. Are financial guarantees excluded? Do we exclude lease receivables? What about ownership in a debt fund, which underlying are all bonds or contract assets, which reflect accrued income on the financial statements? Okay, here again, we got a fairly split response, but the right answer is units in a debt fund. Financial guarantees, lease receivables, and contract assets, all three are part of expected credit loss measurement under IFRS 9. Units in a debt fund typically get classified as FVTPL. They are neither amortized cost nor fair value through OCI, and they do not meet the SPPI requirements directly. So you don't apply ECL requirements to units in a debt fund typically. So that was a trick question. Okay, Mohammed, we have you on number 2. We are approaching midpoint of the quiz now. So which of the statements regarding the accounting of goodwill and other intangibles is not correct? So impairment recognized cannot be for goodwill cannot be reversed. Goodwill is remeasured for foreign currency changes. Intangibles can have infinite life. Goodwill is not assessed individually for impairment. So the first option, so it's very important that key distinction between goodwill and other intangible assets is once you recognize an impairment loss on a goodwill, it cannot be reversed. Even if subsequently if the valuation improves, this is like a permanent adjustment to the carrying value of goodwill. Once it is impaired, it cannot be reversed. So again, an ECL question, which of the following is not a component of ECL calculation? Effective interest rate, market rate, exposure at default, or probability of default? So let's look at the answer. So I think yes, most of you have got it right. ECL is a measurement of credit risk. It is not a mark-to-market measure. So while we look at the effective interest rate on the contract, we look at probability of default and we look at the exposure at default. We don't really look at the market yield or rate, or that does not form part of the equation in the calculation of ECL. All right, Mohammed, you're on pole position now. So when we look at fair valuation of real estate, what do we look at? We look at the current, when you're looking at fair valuation, do we look at the current use by the owner? Should we look at the future use by the potential buyer? Or should we say it doesn't matter, it should be the highest and best use by a market participant? Or we focus on future plans of continuing use? So again, very split out answer. So again, this is one part of IFRS 13, which we don't pay enough attention to. So the definition of IFRS 13 is different for real estate as compared to financial instruments. The standard says when you're measuring fair value of real estate, you should focus on the highest and best use by a market participant. Now, the concept of highest and best use is also embedded in the global RICS valuation of real estate, which is what the real estate valuers use as a global benchmark. But it is not a hypothetical highest and best use. It should be commercially feasible, financially, legally possible, financially feasible, and commercially viable for you to apply the highest and best use. So, for example, if I have a building in Bahrain which is currently occupied only 10%, I should look at if a market participant would use or acquire this building, what is the best level of occupancy we think they could achieve. Obviously, if you say 100%, then you have to look at whether it is in the current market environment or based on your own assessment, whether you think it's financially feasible, or in the current market environment, you can expect 100% occupancy. But you don't need to start at 10%. You will need to look at what is the highest and best use by a market participant. So one finer points within IFRS 13, which we normally don't focus on. Which of the following is not a defining feature of a derivative under IFRS 9? So should it value change in response to one or more underlying variables? It should be quoted or listed. It should have small initial net investment, and it is something that will be settled at a future date. So which of the following is not a defining feature of a derivative? So again, I think a lot of you have moved towards option 3, but there is no requirement for a derivative to be quoted or listed. The 3 key components of definition of a derivative is that it has to be linked to underlying variable, and your value changes depending on the response or change in the underlying variable. Your initial net investment in a derivative is very small. So for example, when you take a forward on day 1, it has a 0 value, or if you buy an option, It has a smaller net value. Does not reflect the gross value of the notional. And this is something that will be settled at a future date. So these three are fundamental attributes of a derivative. There is no requirement for a derivative to be quoted or listed. In fact, most of the derivatives are over the counter, but negotiated between two counterparties following global norms such as ISDA. So again, a kind of a trick question from my end. So for which of the following are estimates required? Do I need to make estimates for determining whether an arrangement contains a lease, come up with weighted average cost determination for inventories, coming up with measurement of ECL or impairment for trade receivables, or when I classify an instrument as debt versus liability? I think, sorry, this should have been debt versus equity. Anyway, it was the wrong option. So I think that, yeah, the majority of you got it right. So here, again, the question tries to differentiate between estimates and judgments. Classification of a lease or getting a debt or equity conclusion is more of a judgment. Getting weighted average cost of inventories is not a judgment. It's a calculative number, so there's no estimate or judgment applied. But coming up with impairment or ECL is where you use estimates to come up. You'll also use judgments, but this is one area where you predominantly use estimates in determining the carrying value. When segment reporting applies for the first time in an interim period, which of the following statement is correct? So I don't apply segment reporting in an interim period because it is only required for the annual financial statements. I don't need to disclose comparators because in the previous year we didn't do it, and the comparator for disclosures will be annual, whereas the current period would be interim. Okay, here again, this standard part is not well explored. So when will I get qualify for segment reporting in an interim period? So if you list your equity or you list a bond in an interim reporting period, which could happen for most corporates, segment report will mandatorily trigger, whereas for a non-listed corporate, you would normally not apply segment reporting. So when you apply segment reporting, the way IS 34, the interim reporting period standard is written is, it asks you to provide an update on your segment from the prior year end. And in the basis of conclusion of the standard, there was a deliberation between the board because US GAAP or the FASB kind of has taken a view that you don't need to produce segments in interim reporting periods for the first time because the amount and extent of disclosures you need to make will start from the year-end financials and going forward you disclose. But within IFRS 8, I think ISB is very clear. Even if you apply segment reporting for the first time in an interim period, you would apply it for full, including equivalent amount of disclosures in the comparative. So in the consolidated financial statements, transaction costs associated, which of these following items cannot be capitalized? When you acquire FVOCI shares under IFRS 9, when you're acquiring an investment in associate, you account under IFRS 3, a business combination of a subsidiary under IFRS 3, or acquisition of a debt instrument, for example, a normal bond. So in which scenario would you not capitalize transaction cost? So again, the majority of you have got it right. So if I acquire equity shares, which is FVOCI, I'm still allowed to include transaction costs in the initial measurement. But if it is a FVTPL instrument, I cannot include transaction cost in the initial measurement. Acquisition of subsidiaries, IFRS 3 specifically precludes capitalization of any transaction cost, whereas IS 28, which is the acquisition of an investment in an associate, while it refers to IFRS 3 for accounting, the standard still talks about initial recognition as cost, and the definition of cost normally includes transaction cost. So under IS 28, we still continue to capitalize transaction cost, and the acquisition of a debt instrument, transaction cost is pretty much part of the concept of amortized cost to include. So one technical glitch, if I may say, within the way ISB has written standards is, while you refer to IFRS 3 for accounting of associates as well, but because IS 28 was not amended the same way when IFRS 10 and IFRS 3 was amended, you have this disparity between the two standards. And if you acquire a subsidiary, which means that if you acquire 51% in a company, you don't get to capitalize transaction costs, but if you acquire 45%, you get to capitalize transaction costs, which is kind of an anomaly. But the equity accounting project is under review. This is, I think, in one of the agendas of ISB to look at. So we expect this part to change in the future periods, but as it stands, this is one anomaly in transaction cost accounting amongst all categories of financial instruments. So this is a bit interesting one. So income from temporary investment of borrowings that are eligible for capitalization of borrowing costs is treated. How is that treated? So you get borrowings to say build a plant, set up a plant, and in the interim you earn income on those liquidity because you're not fully deployed it. How do you treat with the income on that liquidity? Yes, most of you got it right. So this was a recent IFRIC discussion. I think before the IFRIC discussed, there was kind of dissimilar accounting or diversity in practice, if I may put it that way. So the current IFRIC conversation is very clear that you need to deduct it from the borrowing cost, which will eventually capitalize. Previously, there were different kind of treatments that were being argued that this is income. It does not meet the definition of borrowing cost because IS 23 only talks about borrowing costs that get capitalized. IS 16 also talks about capitalization of borrowing cost. Both these standards do not specifically address what do you do with income that is earned, because income usually always goes to the P&L. So I think this IFRIC discussion, when they've looked at both IS 16 and IS 23 together, they have clarified that this should be deducted from borrowing costs which get capitalized eventually. So moving on to the next question. So Prashant, you're having a streak with 3 correct answers. So IS 19, so which part of your measurement of defined benefit plan is not recognized in profit and loss? The current service cost, past service cost, the net interest on the defined benefit liability, actual gains or losses, or gain or loss on settlement. This should be a straightforward one, most likely. I think people haven't spent time looking at the questions properly. And so the actual gains or loss is not recognized in profit or loss. It is actually recognized in OCI. When you assess it on actual basis, everything else that is a current service cost or a gain or loss on settlement eventually gets reflected in the P&L. Moving on to the next question. Which of the following is considered an adjusting subsequent event after the balance sheet date? So last year, obviously, we've seen a lot of instances on how do you deal with COVID. The World Health Organization declared COVID only as a pandemic in early March. It was 11th or 12th of March, if I'm not wrong. So this part of the standard has got a lot of prominence in conversations going forward. So majority of you have got it right. So if the market value crashes subsequent to the year end, if there is a fire in your warehouse destroying all your inventories, I can't actually read the third option because of the lights. A pandemic event that happens after the balance sheet date, COVID is a classic example. These are all subsequent non-adjusting events. But if an entity goes into liquidation and you are no longer a going concern, IS1 actually requires you to treat that as an adjusting subsequent event. And this was again a recent IFRIC discussion where a question was asked that if I'm preparing financials, for example, for 2014 today, and I know I've shut down the company today, how should I prepare the 2014 financials? So IS1 is very clear. If you're no longer a going concern, even the 2014 financials will not be prepared on a going concern basis. We'll have to treat it on a non-going concern basis. So that remains to be a adjusting subsequent event. So PP revaluation should be carried out annually, once in 2 years, once in 3 years, at least once in 5 years. What does IS 16 permit you to do? Again, this should be a straightforward answer. If you look at, again, this is PP, not investment property. So funnily, IAS 16 actually gives you a lot more time. You don't need to revalue your PP every year. You can do it cyclically or based on triggers, but there is no mandatory requirement to do it annually. But in our parts of the world, if your PP is actually pledged to a bank on a loan, they ask you to actually get it revalued annually, but that is more on because of contractual requirements, not driven by an accounting standard. Moving on. So this is a bit tricky. When you consolidate an open-ended fund, so this is a question, when you consolidate a fund, you will get non-controlling interest. So let's say you own 60% in the fund and 40% is owned by other investors. You get that 40% non-controlling interest. How do you classify that in the consolidated financial statements? Part of equity, part of liability. You don't recognize it at all. You only book your own net shares, or you net it against the assets. Okay. Like I said, this was meant to be a trick question. The correct answer is liability, because in the financials of the fund, units are equity. But when you consolidate at a group level, it does not meet the definition of equity, because units in the fund are redeemable. And anything that is a contractual payout at a group level does not meet the definition of equity. It becomes liability. So when you consolidate a fund, the NCI associated with the fund is normally shown in liability and is not part of equity, nor are you allowed to net it off against the assets and only show your share of assets. Again, something very relevant to the current times, a public cloud-based software access arrangement, the SaaS kind of arrangements which you talk about. How does it get classified? Is it a lease arrangement? Is it a service arrangement? Does it give you access to an intangible asset, a contractual right? Or do you look at it as a service concession arrangement with the cloud service provider? Again, I think most of you got it right. So a public cloud-based software, you don't have control over it. You have limited access. You cannot define how the software gets used, and you don't have control over changes to that software. So typically, it does not meet the definition of an intangible asset. It is a service that is being provided. It also does not meet the definition of a lease. So a service arrangement is the right way to look at it. But there are a lot more private cloud arrangements that are coming into being from a structure standpoint, and private cloud arrangements could have a different answer. So something worth watching for in the future as we all start working in cloud-based arrangements more and more going forward. Moving on. So which of the following is a change in accounting policy? When you correct an error in the prior years, when you change from a cost to revaluation model for measuring PPE, when you reviewed the residual value of a depreciable asset and you change it, or when you change the method of depreciation during the current year. Let's say you move from straight line to unit of account, or one of the different methods of depreciation. So the correct answer is, most of you have got it right. Only when you move from cost to revaluation, it's a change in accounting policy. The other would either be as a change in estimate, or it would be a prior period error. We can move on to the next question. This is self-explanatory. Coming back to goodwill, IFRS 3 states that goodwill recognized in a business combination is an asset which arises from. Is it reflecting the good reputation of the business you acquired? Is it reflective of the customer relationships that you acquired? Is it reflection of values of assets that are individually not identified? In simple words, I don't know. Or is it because it is individually identified? So, right, the correct answer is third option. So goodwill is something that is not identifiable, like we discussed earlier. You know why you're paying for it, but in a way you are not able to exactly say what you're paying for. So normally goodwill is ascribed to staff, because staff is not a qualifiable intangible asset that gets recognized. It is attributable to synergy, value of synergy, because synergy value cannot be defined from IFRS 3 measurement standpoint. So goodwill is attributable to something that is not identified. Moving on. Another goodwill question. So once you acquire once you obtain goodwill in a business combination, how would you subsequently measure it? Would you do costless accumulated amortization? You'll keep it at cost. I think the amortization part got repeated twice, or is it costless accumulated impairment losses? So you're in a way picking from two. Yes, I think the last option is correct. So goodwill is subject to impairment. You don't amortize goodwill. I hope that's the last goodwill question. So IFRS 5 again. In order for a non-current asset to be classified as held for sale, the sale must be highly probable. So in practical terms, what does highly probable mean? I have interested parties who are approaching and talking to me. I have to sign the contract only, or management is committed to a plan, is actively looking out for a buyer, or it is, in my view, it is likely to be sold in the current market condition. Markets are good. I think the third option was correct. Step one is management has to be committed to a plan to sell. If a buyer approaches you, that is not good enough. You have to be committed to a plan to sell, and you should be actively marketing it to a buyer at its reasonable fair value. So if you're even actively marketing at a crazy price, the standard says then don't call it as held for sale, because this does not meet the criteria for held for sale. We have again a few more new names popping out to the top 5 chart. Oh, I'm sorry for another goodwill question. It seems to be the favorite topic, and I'll probably tell you why later at the end of the session. So how often should a goodwill be tested for impairment? Now, a lot of goodwill impairment questions, because I think that's what most of us have been doing, impairment tests over the last 12 months. With COVID, we have been questioning and challenging everything that we see as a static asset in our balance sheet. Yes, you're right. Goodwill is something that is to be tested every year, even irrespective of whether you see an indicator on impairment or not. Whereas corporate assets and intangible are trigger based. Only if you have an indicator, you do the test. Whereas for goodwill, you actually have to do a test every year, irrespective of whether you see an indicator or not. Moving on. So contract costs, this is IFRS 15 question. A contract cost incurred in relation to a contract with a customer must be recognized as an asset if they are not expected to be recovered, an asset if future performance obligations have not yet been satisfied, an asset if they are related to performance obligations which have been satisfied, or you have to recognize it as an expense when incurred. So the correct answer is the second one. So contract costs are like cost of acquisition of a contract for revenue. You capitalize them and release them along with the performance obligations as you recognize the performance obligations against which you recognize revenue. You don't need to expense it immediately as incurred, but it has to be linked to your performance obligations and cannot be delinked. So again, this is a tax question. Most of us have forgotten this topic, other than our personal income taxes in India. So current tax should be measured using tax rate and tax laws that have been. So if you see IS 12, it has a lot of play around in what is enacted, what is substantially enacted in the financial statements. Do you look at something that has been issued after the reporting period till the date of authorization, or do you only look at till something that is the end of the reporting period? So again, IS 12 does has its own complexity. It's a very complex accounting standard on its own. So the standard says if something that is enacted or substantively enacted by the end of the reporting period. Now, substantively enacted is the process of how it gets approved. But if it is substantively enacted before end of the reporting period, you consider that for measuring tax assets and liabilities. But if it is enacted subsequently, you don't consider that for measurement of tax assets and liabilities. Moving on. So which are the factors that help you to determine an entity's functional currency? Currency that drives sales and goods and services, currency that influences costs, currency that is the primary source of funding of capital or debt, or all of the above. Well, you know what has happened when you picked all of the above earlier. At this time, that is the right answer. So you have held your grounds on the all of the above. So that is a good one. Moving on to the next question quickly. So the concept of stewardship, with respect to the concept, which of the following statements is true? This has been added to IS 1. This is something that was added to IS 8. This is something that was introduced in the conceptual framework, or such a concept does not exist within IFRS. This is just some good corporate governance concept, nothing to do with accountants. Yeah, majority have got it right. So in the 2014 amendment or 2018 amendment to the conceptual framework, the concept of stewardship has been brought into the conceptual framework. So it is not only about reporting financial position and financial performance, it is also looking at whether that information gives you adequate ability to have a dialogue with management on their stewardship of resources of the entity and the performance. So this is one of the concepts introduced in the conceptual framework, and this will drive a lot of our disclosure standards going forward as well. So IFRS 12, with respect to unconsolidated subsidiaries, which of the disclosure is not required? So this is IFRS 12, disclosure of interest and other entities. Do I need to give the name of the unconsolidated subsidiary, the principal place of business, name of the other principal shareholders, or proportion of interest, ownership interest held by the investment entity itself? You're right, most of you got it wrong. There is no requirement to give the names of the other shareholders. You have to talk about your involvement with the unconsolidated subsidiary or the unconsolidated structured entity, as IFRS 12 looks at it. You have to talk a lot or disclose a lot more about your involvement, not about who the other shareholders are. Three more questions to go. So IFRS 10, when assessing if an investor has control over an investee, under IFRS 10, which element is not something that you would be considering in your assessment? So you look at substantive rights that give you power, you look at exposure to variable returns, you look at trigger-based protective rights, or you look at the ability to use the power over the investee to affect your returns. So again, we have equal vote between exposure to variable returns and protective rights. So again, the consolidation model is a three-step model. You look at, you assess power, you assess variability, and you assess linkage. Linkage is the fourth option, which is the ability to use your power to actually affect your returns. You need to have variability to returns, but the first question is power. So when we assess power, the standard says you only focus on substantive rights. You don't focus on protective rights, because protective rights will only get triggered on certain events which are not considered relevant or significant for the normal ongoing operating control of an entity. So we normally don't look at protective rights when we do a control assessment under IFRS 10. So which of these following financial instruments cannot be classified as FVOCI? So I have 2% equity shares in a listed entity. I have corporate bonds, normal bonds. I have units in open-ended funds, and I have a perpetual instrument or a preference shares. Which of these cannot be classified as FVOCI? Again, I think we did discuss about it earlier. Very clearly, you've not been hearing to what I've been saying. So 2% equity shares in a listed company, I have the option to irrevocably elect FVOCI. Corporate bonds, if it is within a business model of both held to collect and held for sale, I can get FVOCI classification. A perpetual instrument or a preference share by definition would be an equity instrument. So again, the FVOCI choice of irrevocable election is available on day one. But units in an open-ended fund do not qualify either for SPPI and don't qualify for equity instruments either. So they will usually be measured as FVTPL. You don't have the choice to bring them as FVOCI. So this is again a common mistake we have seen in the adoption of IFRS 9 and the interpretation of the standard. And the last question for the day. In a held for sale associate that does not meet the requirement of IFRS 5 anymore, how would you apply equity accounting? So last year it was held for sale. It is no longer held for sale. You would apply it prospectively from the current period, prospectively, but by adjusting the retained earnings from the beginning of the period. You would account the cumulative change as a change in equity accounting for the current period, or you will apply it retrospectively. So again, the correct answer is retrospectively. Again, when you account for associates under IFRS 5, you stop equity accounting. So let's say 1 year has passed by and it is no longer qualifying for held for sale under IFRS 5. The standard says, well, you got it wrong, go back and restate for equity accounting from the time you discontinued. Similar to depreciation, you stop depreciating assets under IFRS 5. You have a similar pattern for associates. So I think that was the last question. With that, we'll probably close the quiz and see how we have fared overall. So we have Ram on the third position. We've got Rajesh on the second position. And we have Vatsala on the first position with 28 out of 50 right. So congratulations to the top three. And we have two additional runner-ups in position 4 and 5. So, Mohammed? No. Okay. So, I know I kind of mixed it up a little bit. The idea was to not make it very easy for all of us. It was just to try and challenge. I know most of you would, in your subconscious, kind of know what is the right direction to look at. We are not playing buzzer rounds every day. We still need to read our book and get this right. But there are these smaller nuances, a lot of focus on standards which you are not looking at the pre-COVID era. But with COVID kicking in, we have looked at climate change affecting financial reporting, how it affects the various other standards. And we have looked at this mix of questions where we could probably have a lot of tripwires where we could kind of go to the wrong direction if you don't assess it properly. So I enjoyed hosting this session. I hope you all had a very good time as well, and you found the questions interesting. Well, most of you know me, and you can feel free to reach out to me if you think any of the questions probably require further deliberation. But with that, I would again like to thank all of you for being patient listeners to this quiz and participants, and to CA Ajay and the ExCom of the BCICI for giving me this opportunity to have the session with our colleagues in the fraternity. With that, thank you very much, and I would now hand over to CA Clifford.
Thank you very much, CA Mahesh. I hope everyone has enjoyed this session. Now I request our chairperson, CA Ajay Kumar, to present a token of certificate of appreciation to our speaker. Thank you, CA Ajay. Dear friends, before we conclude for the raffle draw, so let me give a vote of thanks. Let me start by extending our gratitude to our chief guest, His Excellency Piyush Srivastava, our guest of honor, CA Nihar Jambusaria, ICAI President, and CA Debashish Mitra, ICAI Vice President, for joining us despite the busy schedule and participating in our celebrations. We thank you, CA Mahesh Balsubramaniam, for your enlightening presentation on IFRS, and I'm sure our members and guests have a lot to take away this evening. On behalf of Bahrain chapter of ICAI, we thank you to address the members of Bahrain chapter on the topic which is close to us. We thank our Bahrain Indian School for giving BCICI the opportunity for tree plantation in the school premises during CA Day, which our members went yesterday to plant the trees. We also thank all the members for the wholehearted contributions to CABF by Padayatra direct contributions, and contributions through the commitment points. And of course, we thank all our sponsors, KPMG, Grant Thornton, MMGS, and Escher Consulting. We thank Ajit Nair and his team from Convex for hosting the BCICI virtual studio. And how can we forget to thank Macro Bakes for this lovely cake. It is made in India. Last but not the least, we thank all the executive committee for the wonderful organization of this virtual meeting. And to our dear members and guests, without you, it wouldn't have been possible. And we thank you for taking out your precious time and attending the meeting. Thank you and God bless you all. Now, for the exciting session for the raffle draw, I'd like to call upon CA Ajay, our chairperson, to conduct the raffle.
Hello, everybody. So I'm back again. So we will have 10 raffles. So members who are there, you can please unmute and speak so that we understand that you're there. So let us start. So you can see my screen, I guess. So let us start with the very first winner. CA Sanjeev Mahapatra.
Yeah,
are you here?
Yes, I am here.
CA Sanjeev, can somebody
yes, I am
confirm
here.
for me?
Yes, he already told he is there.
Thank you. I'm here.
Ajay, he is there. Sanjeev
He
is
is
there.
he's just the king of the universe. You can see him.
Is there?
He is there.
Yeah, okay. I think I can see CM Sanjeev there.
Yes, I am here. Thank you.
Volume.
Ruling all the galaxies. He is there.
Okay, the second winner is CA Arya Ajayan. Are you there, CA Arya?
No, he is not able to see. Not online.
No?
No.
Okay. So that is gone. CA Jose MV. CA Jose. I can see CA Jose. Can you unmute yourself? CA Jose. We can see you there, but if you could just at least unmute.
Only virtually.
Yeah, I think he might have left, not seeing there. Only online available.
Yeah, let's.
But yeah, but anyways, I think online available, we should probably give.
No affirmation.
Yeah, affirmation required, right? Otherwise, might have owned and went somewhere else.
Yes. Yes. Let's move on to Ekansh.
The next is CA Ashish Shirke.
Yes, I am here.
Excellent. That is how we want the members to confirm that they are there. Excellent, CA Ashish.
Thank you.
So we have done now with 3. The fourth one, CA Akil Shah. CA Akil Shah. I don't see CA Akil Shah on the list. So 3, 2, 1, and that's gone. CA Vishali Jain. CA Vishali Jain.
No, she is not available.
Okay, people are missing nice 10 BD vouchers, I think. CA Ajit Pai. CA Ajit Pai.
He is online available, but not sure.
Okay. No, I think his audio is not connected. I can see his audio is not connected. So we will give him the prize. So that's done 4. Haha, CA Uday Shanbag. Is
No,
CA
he's not
Uday
available.
Shanbag?
He is not available.
Oh, that's bad miss. CA Bharat Venkat. So if Bharat is not there, he has to pay
No,
10 BD
he is
as
also
well.
not there. He is also not there.
So I think he has to. Santosh, if you can note that, you should collect 10 BD from him, okay?
Yeah, yes, sure.
Okay. CA Ankush Malhotra.
Hi,
CA
Ajay.
Ankush. Thank you. Thank you, CA
He's there.
Ankush. Congratulations.
Thank you.
Next one is CA Ram Kumar. CA Ram.
Yeah,
CA
I'm
Ram.
here.
Okay. Okay.
But
Congrats, Ram sir.
He's a
Ajay,
quiz winner. You told quiz winner
Yeah.
will not get it, or something like
Winner
that.
disallowed.
Sorry.
He is the quiz winner, right?
I took the third place. So, as per
Okay.
your
Okay.
rules,
So. Okay. Thank you, Ram sir. Thank you for that. I will give the prize to someone else so that more people get it.
Please.
Thank you so much. CA Arun Kumar Rajgopalan.
yeah, I'm here.
Okay. Thank you, Arun. Congrats.
In Saudi.
Another Saudi, Sandeep Sarda. CA Sandeep Sarda. No, I don't see him.
No, he is not there.
He's not there. Okay. So that goes. So there's still four slots left, right?
Yes.
1, 2, 3, 4, and 5, 6.
3, 4, 5, 6 is over.
CA Kapil Batra.
Oh,
Today seems to be the. Thank you, sir.
Yeah,
Thank you.
He is there.
Today seems to be the past chairperson's day, I think.
In India.
No,
Anyway, thank you.
After 7 years, I've got referral.
चले, okay. So आप मुझे याद रखेंगे.
Yes.
CA Mahesh Kumar, like I said, CA past chairperson again. Mahesh.
It's not available.
I was seeing Mahesh throughout the quiz.
Not available.
Arey wah.
But since he dropped the rank, I think he went up.
Okay. So let's pick the 8th winner. CA Sumit Kopkar.
Yes, I am here.
Okay, Sumit. I see that you did not attend the mutual fund class. You are here. Very good. Good choice.
Yes.
So that was the 8th winner. Is it 8, right? So 1, 2, 3, 4, 5, 6, 7, and 8. Yeah. So let's come to the last two positions. CA Gulshan Rai Khanna, our senior member. CA Gulshan Rai Khanna. Congratulations, sir. Congrats, sir.
Always
Noted.
lucky. Thank you.
So that goes the 9th one, and here comes the last prize. Let's see. CA Natasha Gopalakrishnan, ExCom member. CA Natasha.
Available.
You are there. We can't hear you.
Yes, she is there. She is.
I will unmute her. Unmute her. I will unmute her.
We can't hear anything.
Speaking.
I will mute her. Then she will not be able to tell.
And anyways, I think she was the one who prepared the certificate for CA Mahesh Balasubramaniam. So anyway, she needs to get at least good. So that concludes the raffle draws. Thank you so much. I hope thank all of you for joining today's session. And the CA Day celebration, as well as I hope you found the IFRS quiz very interesting. And this is live on YouTube, so you can pick up the IFRS quiz anytime again. And like CA Mahesh said, he's available anytime should you need any further help. So thank you so much, and all the best, and good evening to all of you. Bye-bye.
This was a great program. Thank you very much.
Thank you very much.
Bye. Thank you.